What's up everyone, it's Caddy with MoneyVest. So in this video we are going to be talking about one report that was released by Bank of America suggesting something that has never happened ever in the history of the United States. That is correct. We're going to be going over something that has never taken place in the last 250 years. And it's now happening. So hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. We do have the first week of the month here. Best time to join. Again, you get access to all the members only benefits, intrinsic value spreadsheets, buy and sell alerts, options alerts. Everything's going to be included. September's here, so you never know. If it ends up being a really bad year, I will be buying a lot and deploying a lot of dry powder back into the market. So you want to be getting all those alerts. And of course, fundamental and technical analysis courses are going to be 50 to 60% off in observance of Labor Day. And that is going to be coupon code LABOR4, and that also expires Monday night. So links are going to be down below. So when it comes to the bond market, the 10-year Treasury bond is on track for a third year of losses in 2023. Something that hasn't happened in 250 years of U.S. history. In short, it has never happened, says Bank of America, and that is to say that the Treasury bond has never suffered 3 consecutive years of losses, and the return for investors putting money in the bond stands at a negative 0.3% so far in 2023 after a 17% slump in 22 and just under 4% drop in 2021. And this is the pointing out of that chart here that never in the history of the U.S. Republic have the U.S. Treasury returns fallen 3 years in a row. So the bond market is really struggling on the back of the Fed's quantitative tightening measures, with interest rates obviously going higher as they are. 500 basis points already increased in the last 12 months. Another 25, maybe 50 basis points left for the Federal Reserve to raise further. Not to mention the fiscal department is not doing the job easier as they continue to issue a lot of debt, and interest payments on that debt also continues to eat up a lot of the tax revenues, which forces the fiscal department, the Treasury Department, to raise even more debt at higher interest rates, which continues to repeat that cycle over and over again. And as there is a lot of demand of bonds for U.S. Treasuries, what happens to prices? They continue to struggle. They continue to come down, and not to mention, of course, rates continue to go higher as well, which obviously leads to a lot of underperformance over the years. So that reflects a staggering 40% jump in U.S. nominal GDP growth, factoring in growth and inflation since the COVID lows of 2020, they said, providing this chart. So this right here has only happened twice that we have seen the GDP, nominal GDP, grow by over 40% in 3-year period. And U.S. nominal GDP growth since the start of the expansion cycle, this right here, over 40% the other 2 times in 1979 or 75 beginning in 79, 49 to 52. So that 3-year period, we also saw and witnessed over a 40% increase in the nominal GDP. So that's where we are, and bond rates have suffered this year as the Federal Reserve has continued its interest rate hiking campaign aimed at getting inflation under control. And the big picture in the 2020s versus 2010s is lower stock and bond returns, which we would expect to continue given political, geopolitical, social, and economic trends, as well as what they're referring to. So they do expect lower stock and bond returns moving forward. Now, this year has been better for the Dow Jones and the S&P, but the bounce since COVID pandemic restrictions began to be lifted has been very concentrated in the U.S. stocks, especially technology sector. And with the breadth in global markets, breathtakingly bad is basically referring to how many stocks are actually participating in the rally as well. And this is where we are with respect to the breadth. Since 2003, so in over 20 years, this has been the most narrow breadth in global stocks, meaning a very handful, small percentage of companies are actually leading the charge here with the markets going higher, and other ones still continue to struggle, underperform, stay flat, or straight up be down on the year. So this is where we are with respect to the narrowness of the global markets here. So as for the latest weekly flows in funds, Bank of America reported that 10.3 billion went into stocks. So again, investors are just buying hand over fist. 6.5 billion went into cash and 1.7 billion to bonds, with 300 million being drained from gold. And the yield on Treasury yield, 10-year Treasuries basically was sitting at 4.1%. I think it was a little bit higher last time I checked, sitting at just under 4.12% here, starting to pull back a little bit, but of course did rally right after the unemployment numbers came out. I did a video earlier on the unemployment numbers, so make sure that you do check that out. But the bottom line is that I believe that as long as the Federal Reserve continues to tighten with their Federal Reserve's balance sheet kind of continue to rolls off with the current program of 75, 100, 125 billion dollars, whatever they're doing each month, they're rolling off all these maturities, the securities that are maturing. That, along with the new issuances for all the fiscal deficits that the government is running, is going to continue to keep interest rates pretty elevated for some time. So if you come over to US 10Y, again, we are pushing back higher. We did get a little bit of that rejection of 4.3%, so started to sell right back down. And right now we're once again back higher on the day on this unemployment print. So resistance obviously is going to stay put roughly at around these levels at close to 4.25 to 4.3%. And because of that, so it's kind of like a double whammy, right? So it's two really big problems, because on one hand, you've got inflation that continues to be super tight at 4.2%, specifically core inflation, which is at over 4.2%. And then you've got the unemployment numbers that came out today that are suggesting that, okay, there is some softening in the labor market. We did see from 3.5 to 3.8%, actually 3.6 to 3.8%, but that's still not enough. That's still not enough for the Federal Reserve to pause, at least in my opinion. The market's still pricing in a pause, but in my opinion, it's still not enough. Yes, the Federal Reserve may pause in September, but I think there's still a probability for maybe another 25 basis points in October, November, or even in December, right? We'll find out eventually, but the main goal the Federal Reserve has is to bring inflation down. Core inflation, that's it. They need it at 2% or lower, and right now we're not there. So interest rates are going to keep going higher. That's going to put additional pressure on the bond market in terms of prices to come down, and that's obviously going to put pressure on the economy, and we'll find out if the labor market actually is showing signs of weakness or if this was just a one-off, considering that the trucking company filed for bankruptcy and transportation job losses are pretty substantial, over 35,000. That basically, jumped that unemployed persons from under 6 million to over 6.3 million. So that's where we are. Hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. Now, I know there's going to be a lot of questions with respect to TLT and TMF. I think patience is the name of the game here with the bond market, because as you already witnessed and saw, we have seen significant underperformance for these ETFs, right? So if I bring them back over, you'll notice that on the day it's down another 1.7%, and this right here is the overall chart. It hasn't even recovered since 2020 highs of $160, and it's just been selling off consistently down over 43.5%. So that's the underperformance that they're referring to that hasn't happened ever in the last 250 years, that 3 consecutive years the bond market's been down. So I think patience is the name of the game. I think we're going to have to wait and see where interest rates end up going to, how high they actually end up going to, and then eventually what happens with the labor market and inflation, of course, very, very important metric. And then eventually we'll make some decisions with the bond market as well, because there is going to be opportunity. It's just a matter of understanding that timing. So I hope you guys enjoyed this video, find it helpful. Make sure that you drop a like. Don't forget, first week of the month is the best time to join if you want to be a part of our Patreon and our Discord. And the fundamental and tech analysis courses, also 50 to 60% off. And as always, happy investing. I'll see you all in the next video.